Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors, and welcome back to Real Estate Investing Abundance. I'm your host, Dr. Alan. As always, I'm delighted that you have decided to be with us today. We have a very exciting and informative session for you today as we are looking at building wealth through commercial real estate with Stewart Heath. And I am delighted that he is with us. He is a certified public accountant and has over 20 years experience in commercial real estate. His diverse portfolio includes retail space, medical office, gymnastic facilities, and self-storage. As a CPA and investor, he challenges Wall Street's conventional claim that real estate is an alternative asset, and he boldly asserts that real estate is a fundamental investment vehicle that should be a foundational part of every investor's portfolio. So welcome, Stewart. I am so glad you are with us today. So just take us into the show and start off by sharing with us why real estate should be a core holding in everyone's portfolio.
Thank you, Alan. Appreciate you having me on today. It's quite the honor. And thank you for that intro. Why should real estate be a core piece of everybody's portfolio? Rather a bold statement, given that the public markets seem to dominate everything in the name of investing, and perhaps we can talk later. I think that's going to change over the next few years, but they've got the money, they've got the marketing, and I would say there's one thing the public markets, publicly traded securities, have as an advantage over real estate, and that at the moment is liquidity. If you need your money out, you can get your money out, whether it's a gain or a loss, whatnot. Other than that, the public markets don't, they're exceptionally volatile. They go up, they go down, sometimes for seemingly no reason at all, other than just supply and demand, buying and selling reasons. And if you end up on the wrong side of those fluctuations, then it drastically impacts your outcome. Real estate obviously is a much more stable market. I contend that the real estate market, this would be commercial, residential, everything, is probably about 10 times the size of the world's public markets. And so the idea that it's an alternative asset is almost laughable. I like to joke that it's the original asset. Since the first caveman let another caveman use his cave for 2 goats a week, I mean, that was the beginning of rental real estate, and it's actually the original subscription business. And we know that subscription models are all the rage in publicly traded securities, given the nature of the recurring revenue component. Well, that's real estate, recurring revenue, and everybody needs it. We're all physical beings, and we all have to exist somewhere physically, whether that be a house, apartment, whatnot. But why do I think it should be a core piece? Because it's the stabilized and cash flow nature. I should probably clarify that statement, that I believe that cash flowing real estate should be a core to everybody's investment portfolio. There's many, many ways you can invest in real estate, but it's that recurring cash flow. And even if you look at dividend paying stocks in the stock market, the ones that are paying out cash every quarter tend to be very stable assets. And so to me, it's not the real estate portion, but it's the stability that should be the core of everybody's portfolio. And once you have this foundation of cash flow generating assets, then by all means, go buy into IPOs, go buy some speculative land, go buy a lot of tech stocks, and experiment a little to enhance the gains of your overall portfolio. So that's where I'm coming from. It's the stable and cash flowing nature of the asset.
Well, certainly those are things that I like and appreciate it. And certainly the reason I don't put a lot into the stock market is because of what you just mentioned, the fluctuation. And I mean, I guess people like Warren Buffett could probably explain to us why things are going up and why they're going down, but he spends his days and his nights investigating that. It's not a passive endeavor for people like Warren Buffett. And so I just don't put much into it. And I like the stability of the real estate markets. You had mentioned that you think that this dominance of the public markets is going to shift over the next few years, and that the private placements are going to be taking a more, I assume you meant a more prominent place in the investment world. Why do you make that assertion?
In a word, technology. So there's a couple of paths that I think are going to converge here in the next 5 to 10 years. If you're familiar at all with a company called Arrived.com, and I'm not plugging anybody, but they're they are pioneering a way forward with the use of Regulation A, which is an alternative way to raise funds. You know, the private placements are generally governed by Regulation D. There's some other lesser regulations that people also utilize. But Reg D has been around the longest, and that's generally what's thought of as private placements. Regulation A is actually which came out of the Jobs Act, or its expansion came out of the Jobs Act in 2012, and then has been amended and amended and amended. It's almost a backdoor public offering. Well, it's not almost; it is. So it's SEC regulated, and you can sell securities to anyone who's over 18 years old. And because it's a backdoor public offering and there are recurring reporting requirements, exchanges are starting to pop up where these Regulation A shares will be able to be traded. And you even have some of that going on with the Reg D offerings that perhaps your units have the restrictions on trading of those have expired. There's a lot of sponsors out there that are investing in the tokenization of private securities. All of this is going to be leading to the free exchange of existing shares. The Regulation A that actually is lawful and able to be done right now. What you don't have right now is the marketplace. You don't have the exchange, and there are some popping up. And so then sponsors will need to lead the way to get their securities listed on an exchange so people can get liquidity. And I believe once liquidity comes to real estate investing, you know, the stock market will have had its day. I mean, there's still great investments in the stock market, but you're just taking a risk with all the volatility, which we've already described. Again, once real estate investing has liquidity, I think everybody's going to be pursuing this primarily for the stability. Now, that said, when those units become freely tradable, we'll probably see some price fluctuations going up and down, but probably not more than 4 or 5% from the actual value of the underlying real estate, because that's really what's at stake is what's the underlying real estate worth.
Yeah. Well, you have stated that office buildings are not dead, which many people that I speak to say that that's just a really dead market and no place to put your money at this point in time. So why do you say now is a great time to buy?
Well, I think the problem with saying office is dead is that office encompasses a half a dozen or more subclasses of office. I would rephrase that to say Class A office space is probably not dead, but it's going to go through some serious pain. Downtown Central Business District office is going to go through some pain. I'm sitting in one of our assets now, which is a suburban office building, and I've managed it even longer than I've owned it. And it's full now. It's been full for 5 years. We were full through the pandemic, but this is not a Class A property.
Mm-hmm.
And the differentiator there is, are your tenants customer facing, or are they just having a place for their employees to come and gather and meet? All of the tenants here are customer facing. We have dentists, we have insurance agencies, we have mortgage companies, we have home health companies, and even a church. And this is a go-to place for people to come to, and each and every one of these tenants have to have a place. So similar to medical office, which is another massive subcategory of office,
Mm-hmm.
it's never even had a hiccup. Your doctor's not going remote, and he's not coming to see you, so he has to have a place to keep that MRI and that ultrasound machine, and you're going to have to go see him for the foreseeable future. Medical office, highly competitive market, is a great category, but you hear the financial media, and all they want to do is talk about office,
Mm-hmm.
office. Here's another locational example. So we're close to Huntsville, Alabama, as our operating area. We have several assets down there. Well, that is a massive defense contracting area in Huntsville, Alabama, and even throughout the pandemic, because a lot of those professionals and those engineers work on top secret stuff, and almost every single one of these buildings it will have what's called a SCIF. It's and I don't know what the acronym stands for, but it's a top secret room that blocks out all kinds of electronic signals. They're not allowed to bring in their cell phones, and all the computers they use are already in there, and so those people couldn't work remote throughout the pandemic. And in that sector of the market, the defense industry, that is Class A office space, but it's a subsector of Class A that's really for defense contracting, and it's doing fine. There's no fire sales, and there's nobody down there talking about taking Boeing's old building and converting it to apartments, because Boeing's still using it. It's still quite full. So.
Well, I was expecting you to say that the reason that Office isn't dead is because it is the like Warren Buffett often says, to buy when no one else is buying, and I was expecting that to be the reason for Office, but you've given a very, very different reason for that.
I definitely believe in that.
Yeah.
And we did that in 2021. And when we bought this building, and
Mm-hmm.
people were saying, it's office. Yeah, it's also full. With with a 5+ year
Mm-hmm.
average lease maturity. So there's definitely some of that, and I think that there's a case for speculation for some of this Class A space. And everybody said, well, we'll convert it to apartments. Well, not all of them are going to convert very easily, but that's really not our focus. We like to buy stabilized, cash flowing
Mm-hmm.
assets from day one. We like our value add to be the management that we bring to it, and better leasing, and where we grow that NOI
Mm-hmm.
exponentially over time. I'm not really a speculator. I think there's probably some good deals to be had on some of the Class A office stuff, but I frankly don't know what to do with them at
Yeah.
this point. But somebody clever will figure that out.
So are you finding, I guess, well, I guess the question is, what are the cap rates that you're seeing in the office spaces that you are interested in?
Well, on the buy side, the higher the better, obviously. We just put an LOI on a medical office building down in Birmingham, and our cap rate on that, it was 8.76.
Mm-hmm.
It took us about 90 days just to get to the LOI, just from,
Mm-hmm.
yeah, I'll blame some brokers. But and we really like that one. We'll
Mm-hmm.
be able to tie that one up, and be able to throw off a very nice 7.5 or 8% cash on cash to the investors, from day one. But that's probably the highest that I've seen in a while.
Hmm.
You're in the business, and you got to go out and kiss a lot of frogs before one of them turns into a prince. And so we've probably been through 36 or so deals so far this year that we actually asked for additional information, and that one kind of rose to the top. On our storage assets, we're in the low sixes on cap rates. And storage in other parts of the country is in the high fives. The office buildings that we do tend to be, let's just say, going through some sort of a transition, and therefore the cap rates tend to be a little higher. The retail building we did in December, which is very similar to sort of what I call suburban office. They're service retail, not a lot of stores, but they're service businesses that where their customers come there. So fairly similar cap rates. The one we did in December, we bought at an 8 cap. And we were pleased with that one because it was also full and had good leases. So,
Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. So are you finding this to be a tight market? Is it definitely a seller's market like the multifamily is now, or is it a little bit looser?
I think markets are highly localized. I think that takes, that's rule number one in real estate investing: location, location,
Mhm.
location. And so in Middle Tennessee, Northern Alabama, these are very vibrant communities. I've seen a little bit more balance come back to the market this year. Last year was a horrible year for deal flow. Sellers were not willing to come to market with the new prices based upon the interest rate rises. That seemed to change in January, and a lot of good quality stuff has hit the market at much more reasonable prices. I'm not going to call it a seller's market, nor is it a buyer's market right now. Where I work, it's a balanced market, much more balanced than it was last year.
Well, I think that's a good sign.
I
Hopefully,
do too.
things are moving in a direction where inventories can start moving again. You say you don't care about interest rates, whether they go up or whether they go down. What do you mean by that?
Yeah. Um, so my second rule of investing is, you make your money on the buy, not the sell. And because I'm trying to drive to a price that will allow my property, my investment, to cash flow from day one. So it's really more about the price of the property than the cap rate or the interest rate. Interest rates are what they are. I'm gonna put a maximum of about 70% debt on the so I know what my interest rates will be at whatever time that is, and therefore I use interest to back into a price. And if that price is within the ballpark that the seller will accept, then we're good, and we can go do
Mhm.
some business. There'll obviously be some pushing and shoving. When you're millions of dollars apart on that, they've not, in my opinion, that seller has not adjusted to the reality of the current interest rates, or they don't really need to sell that bad. So to me, an interest rate is just a variable in an equation. Yeah, I'm a CPA. I'm a numbers geek. Yeah, I'm just working a formula backwards to get to the price that I'm willing to pay for that stream of cash flow. And so, to the extent whether they go up, whether they go down, obviously I prefer lower interest rates, and that's just better. It's easier to buy. The sellers get a higher price. They're much more agreeable. But at the end of the day, just through the underwriting process, it really doesn't matter. It's just a variable.
Yeah,
So
just
I'm looking for a spread between the cap rate and the interest rate,
yeah,
if you want to get down to it. So,
yeah. Okay. Well, that makes sense. We are talking today with Stewart Heath, and he is the owner and CEO of Harvard Grace Capital. So, Stewart, tell us about Harvard Grace and how it is that we can find you and get in touch with you.
Thank you. Easiest way to find out about us or to get to me is Harvard Grace Capital or harvardgrace.com, excuse me. You could also just go to stewartheath.com, which will point you there as well. You can find our resources and you can find my Calendly link there. And I invite anybody and everybody to who's interested, book a call with me because I can talk real estate all day long. One resource that's free that you might be interested in if you are a passive real estate investor is questions you should ask your real estate investment sponsor, your passive activity sponsor. About 100 questions in there that as you're evaluating a new investment sponsor, run down that list and it should create new questions in your mind. Oh, there's a good one. It's a really helpful resource for passive investors because as a passive investor, your responsibility is not to manage the property, but it is your responsibility to investigate your sponsor and know who's managing your money.
Absolutely. Wonderful advice there. So definitely go to harvardgrace.com and pick up that resource of 100 questions to ask your sponsors. Well, Stewart, what are the 5 reasons entrepreneurs should invest passively in real estate? And I don't think that goes just for entrepreneurs, but high income W-2 employees as well. So what are those 5 reasons?
Well, we've already touched on some of them. Real estate should be the core of everybody's portfolio. I pick on entrepreneurs specifically because they're the ones that are perhaps generating lots of cash, but are still running their business. And so every dollar that they have is essentially invested in that business that they've created. And so they need to start peeling off some of that and creating assets and income outside of their core dream, their asset. So, and you're right, that goes for high income W-2s. So it should be the core of everybody's portfolio. And the tax benefits and this is one thing you don't get when you're investing, even in REITs in the public market, is you get the direct tax benefits when you're owning, and that comes from depreciation and deductibility of your investment interest and all kinds of things that come from that get passed through, whether you can use them immediately or whether they show up on the back end when you sell the asset. Those are tax benefits that you don't get in any other form. There's the recurring cash flow piece that we've talked about. Now, I'm going to have to forgive me. I've got to look at my own stuff. So,
no problem. I have those brain hiccups all the time. So
yeah, I get going and then I'm distracted. Okay.
Equity, is that one of them?
Yes, the building of equity in investments in assets outside of your core investments. Maybe it's your home, maybe it's your business, maybe you're a high income earner and you have a great deal invested in sort of the company stock plan, where you've got a very high proportion of your portfolio invested in your employer stock, which is a great benefit. But everybody needs diversification, and that's the key. You should diversify everything: real estate asset classes, sponsors, and different investment types all along. So, and there's one more, and Ellen, it escapes me. I apologize.
Is it perhaps leverage, or is it cash on
Thank
cash?
you. It's the leverage. It's the leverage. I apologize.
No problem.
So a lot of people may be familiar with margin accounts, where you can borrow generally up to 30 or 50% of the security value, and where you can buy more. Highly, highly risky thing to do, mainly because of that volatility thing that we talked about, because you can get a margin call. Real estate is different, and every lender in the world knows it. And because it is not subject to value fluctuations wildly. You can leverage a piece of real estate 60, 70, 80, even 90% with some lenders when they're trying to quickly build their portfolio of the value, the purchase price, the appraised value. And what does leverage do? It means that you need less of your own money. And real estate is a great hedge against inflation. And as we are in inflationary times, you've locked in the cost of your asset by borrowing money. And real estate, if your leases and your management is done correctly, the revenue will go up. Your operating costs are going to go up too, but your revenue should be going up. But you're going to be paying that back with cheaper, inflated dollars over time. So that's what the leverage does for you, and the bank only gets back what you owe them plus the interest, but you get all the gains going in the future. The equity ownership gets all those gains. And can that math work the same way if you're buying Google stock? Yes, it can, but you've got that volatility risk. So leveraging any kind of an asset actually enhances your returns. It acts as a force multiplier for the equity multiple on your deal. So.
Yeah. Well, thank you. Very good, good things to be thinking about when looking at our investment portfolios. What is your number 1, 2, and 3 rules for investing in real estate?
Talked about 1 and 2. All real estate is local. The problem with that is all financing is global. You get these global rates. Number 2, you make your money on the buy, and we didn't expand on that a whole lot. And what does that mean? Logically, you'd say you make your money when you sell the property. But if you don't buy it right, given everything, because when the seller's selling for a reason and you're buying for a reason, and if you're not doing your due diligence and knowing everything that needs to be done to the property so that you can execute your business plan on that property, and every property has their own business plan, and everybody needs to realize that it's not just, hey, we're going to buy it and rent it. It's quite a bit more detailed than that. So you have to evaluate everything that you've got to put into the property in order to get it to where you want to go. So all of that's done on the buying end. My third rule of investing is really stability. And these are my rules. I am not against speculation. I don't do development. I've done development in the past, and it's exceptionally risky. So I should call this rule risk mitigation. The way we buy properties, we eliminate the interest rate risk. I'm sorry. Yes, we only do fixed rate interest when we're buying because it's stabilized and you can get a fixed rate product. I don't do any development. So we don't have development risk, which can massively impact your investment. And so our only risk typically will be vacancy risk. So, and the one thing you need to know is that every business that your tenant is in, you are in. And especially if you've got a tenant in a property that's a big percentage of that property, you need to be concerned about that type of business that they're in, and what's the future for that, and which sort of takes us back to the whole problem with office properties, where all those businesses got tenants, and got employees that don't want to show back up. So it's always the case, and doing a tenant evaluation is always a massive part of going into a new property. And like everything else, you want diversification in any kind of a multi-tenant property. I tend to avoid single tenant thing. And while you can get great cash flow on your average Walgreens or Dollar General, and those are interesting properties, I remember a time where some of those operators just sort of went around the country. I'm closing that one, that one, that one. Oh yeah, and before you know it, they've closed 1,000 stores. And then what do you do with a Family Dollar or a Dollar General building that they're not in? A liquor store? Yeah, I don't. What do you do with those? And there's Some of them may be in great locations. Some of them might not be. So risk mitigation would be my third rule.
Well, that in terms of offices versus multifamily, before we went on the air, you were talking about the fact that you don't do multifamily because of, well, there's a lot of headaches with tenants in terms of multifamily. But generally speaking, in a multifamily of 100 units, there's 100 possibilities for rental, and it's very unlikely that all 100 are going to leave at one time. When you're
Right.
looking at office, even the type of offices that you're looking at, I'm assuming you have anywhere from, I don't know, 5 to 10 to a dozen or so tenants. Even just one of those leaving is going to leave a big hole
That's correct.
in that in that process. So talk about that risk versus the risk of multifamily tenancies.
Yeah, let me just clarify. I think multifamily is the foundation of all commercial real estate, and my not doing it is twofold. We do manage everything that we bring to market, and so there's a personal piece of me that doesn't want to deal with residential tenants. I've been there, done that, and also I have yet to find. I underwrite lots of multifamily deals, but I have yet to find the one that's going to cash flow from day one. And because it's such a popular and probably the most stable asset class, they trade at very low cap rates, and they trade at prices that I'm not willing to pay. So I don't know that multifamily is ever in my future. But you're absolutely right. I guess your average multifamily lease is a year, and then somebody turns over, and then you got to go in there and you've got a little bit, maybe touch up paint. You got a little expense. What I like about the suburban office or even the medical office world, suburban offices, uh, I might have a vacancy for 90 days to 6 months as a tenant turns over. Generally, that tenant is under obligation to white box that space, where they got to put it back into the condition that it was in, or else we're going to rumble. We'll have a problem, so to speak. And so that keeps cost off of me. And then once I lease it again, I generally am not going to have any issues for minimum of 3, probably 5 years. In the medical office space, it's a 10-year deal, maybe a 15-year deal with a couple of similar options to renew. And at the renewal times, okay, yeah, you'll go in, you'll replace some carpet, maybe some paint, and stuff, which is actually a bigger hassle for the tenant than it is for us because they're already in there. Anyway, to me, I just like the long-term nature of the tenant relationships. Occasionally, not very often, maybe 1 in 100, you're going to have a tenant go bad. And much more often you'll have one that doesn't renew on their renewal date, and that's their right. But if you go back to rule number one, location, 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 you're minimizing your vacancy times. So I would just say my own mindset just lines up better with commercial tenants than it does residential tenants.
So I guess in terms of risk management in your underwriting, you're accounting for that 90 days to 6 month vacancy so
Yes.
that so that it's not a surprise when that happens. So
Yeah, as we spread the leases out, we always do an underwriting case where everybody does not renew at the end of their lease, and so you build in a 6 month period in there, and that's not going to happen because just like in probably what's true multifamily, most people stay probably 2 to 3 years would be my guess. Most commercial tenants stay. Retail people don't want to move. It's just like in storage. Once they're in 3 to 4 years generally.
yeah.
So yeah, so you're you underwrite as if they're going to leave, but then you manage it as if they're going to stay. Yes.
Well, we are talking today with Stewart Heath, and he is with Harvard Grace Capital, and you can find him at harvardgrace.com. Thank you so much, Stewart, for being with us. Very enlightening conversation.
Thank you, Alan. It's been a pleasure.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off, passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.